Hello everyone. Firstly, it's been almost 5 months of work from home stroke lockdown for most of us. So I hope each one of you is absolutely safe and secure in your respective homes, at your workplace. And for those who are in Mumbai, I know it's been 48 hours of non-stop rains. So I just hope that all of you are absolutely safe and even sheltered from the torrential rains. We saw the monetary policy decision today where it was a unanimous decision to keep the benchmark India rates on hold, both the repo and the reverse repo. This was by and large in line with our expectations. We had guided the markets, or we had guided our investors towards this outcome. It was a close call, no doubt, which is why we saw quite divergent views across the market participants. However, if you actually go through the genesis and the reasons quoted by the MPC to be on hold, it's very evident that they do not want inflation to clearly shoot up quite dramatically. While the central banker does not have a role in inflation moving up and down because it's largely due to demand and supply side constraints. However, the pause indicates that they would like to see some sort of a receding inflation trend line and then resume their accommodative rate action than jump the gun right now. The liquidity in the banking system is fairly adequate, so that is all in all likelihood likely to keep the rates absolutely on a benign footing. However, market participants have not written off hopes in terms of further monetary easing, and we do completely subscribe to the similar view. World over, if we see the benign interest rate stance and the job or the activity of pumping steroids continue, and therefore, while India has to be mindful given the fiscal deficit overshoot likelihood, it is imperative that we had this kind of an outcome. How did the markets react? Well, the markets have seen a sort of a mixed reaction. The very short end of the yield curve has not moved much, but the mid to long end of the yield curve has backed up by 5 to 10 basis points, which is natural given the status quo on rates. So some giving up of positions was natural. Do we read significantly into this and expect a U-turn in rates from the current juncture? The answer is a clear no. For reasons articulated earlier, A, the accommodative bias continues, B, the liquidity in the banking system is more than comfortable, and C, there is tepid growth in the system, whether it is the world economy or for that matter India, we continue to grapple with a lack of growth. Given all these ingredients put in and blended together, we maintain the fact that if you have longevity of investments into the fixed income markets, there is scope for gratification. What should you do as an investor? Firstly, please don't get dejected that there has been no rate cut and you did not get that instant gratification through potential capital gains. We are in for the long haul. So long as the COVID or the medical world emergency finds a tangible solution, it is highly likely that the yields will be anchored around the current levels. So please keep in mind the longevity and the risk appetite that you have when you are making investments in the markets, specifically on the fixed income side. It is very, very important, I would reiterate, to stay the course and not deviate from the horizon set ab initio while making the investments. On that note, stay safe, stay healthy, and please remain invested. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.